Mark Twain once wrote, October. This is one of the particularly dangerous months to speculate in stocks. The others are July, January, September, April, November, May, March, June, December, August, and February. Hi, my name is Cliff Nelson. I'm the owner of Redwood Tutoring, and I'm a teacher by profession. I'm a mathematician by training, but one of my passions and hobbies is investing in the stock market. I bought my first shares of stock in January of 2006 when I invested $300 into IBM. Now I was able to sell that in January of 2012 for $730. I didn't really know what I was doing at the time. Since then I have learned so much, and this video tutorial I want to share with you some of the key ideas of what I've learned. Now it's not just me and it's not just IBM. In around the time when I was born, in the summer of 1982, the Dow Jones Industrial Average was trading for about $800. Now, as I'm speaking in the summer of 2012, the Dow is at $13,000. So in 30 years, 800 to 13,000, pretty good return. Now, despite all the advantages to investing in the stock market, I think a lot of people find that they get burned, and they also find a lot of uncertainty. If they put their money in the stock market, they feel that it's subject to all types of risks that they don't even understand. And all that they know is that sometimes it goes up, sometimes it could really go down. This tutorial, I want to ask and answer questions such as, well, what are stocks? What are corporations? What are mutual funds? Why would a company even issue stocks? Why should we invest in stocks? Also, how can you determine, or at least estimate, what the long-term performance of stocks are going to be, whether it's going to be up, down, or just sideways? Also, I want to talk about speculating versus investing, and I want to talk about how might you organize a portfolio. There are so many topics that I want to talk about, but let me first of all just tell you what this program is not. This program is not a get-rich-quick scheme. I am personally skeptical about such programs myself. This is not a type of program where I have a secret agenda, where I am trying to promote some shares of some company so that I could receive a commission. Nor is this the type of program where I'm going to get your contact information and then sell along to others for a profit. Instead, the only compensation that I expect to receive for doing this is through your purchasing this video series. Now, let me close by just giving you something that might pique your interest. I think everybody knows that the long-term performance of stock is related to how the company does and how it's increasing its earnings. But yet there's a lot more to it than just that. If I go back in time and I look at what IBM was producing in profit per share in 2005, well, by the time 2011 rolled around, the earnings per share of IBM stock increased by 168%, which was pretty good. And that's related to the $300 investment becoming $730. Now, on the other hand, Google increased its earnings per share far more during the same time period. From 2005 to 2011, earnings per share increased by almost 500%. But yet, $300 invested in Google in January 2006 would have only been worth about $370 in January of 2012. Now, what is the factor that accounts for the difference? These and other topics I would like to explore together with you. If you have any questions, please email me at cliff@redwoodtutoring.com. This is Cliff Nelson. Thank you for your time.